Thanks everybody for joining this edition of Market Matters. For those of you that haven't had a chance to meet yet, my name is Todd Jones. I'm the Chief Investment Officer for Gratus Capital. Thanks for joining us today. This will be a kind of one of the special editions, I guess you'd call it, where we do a more thorough quarter-end review, maybe a look at briefly what happened in 2021, and then some thoughts that we're having for 2022. You'll also see here right in front of you the agenda for today. We'll do a broader economic update, 2021 review, some 2022 investment ideas, and then a newer item that I wanted to add here for the future would be key risks to our outlook, because I do think that's important to keep an eye on how how and what could change some of the thinking with what we're implementing in portfolios today. Let's turn briefly to the economic update. Well, I would say, broadly speaking, economic data is very supportive for asset prices and looks very accommodative for the foreseeable future. We do need to recognize there are a few wild cards out there, and I think I include this as the first slide, actually, to suggest that there is going to be quite a tightrope that the Federal Reserve is having to walk here. And that's been expressed in a variety of different ways, not only in testimony that Jay Powell's been giving. I think it's today he's giving some testimony, but also some op-eds from some former Federal Reserve governors that are expressing concern about the direction of monetary policy. And what you see on the screen in front of you is a summary of the dot plots, the Fed's dot plots in yellow. This is the average expectation of what the federal funds rate will be at the end of 23, 24, and 25. You'll also notice the actual Fed funds rate here in orange, the historical response once the Fed is considered raising rates, what that's actually looked like, and what the market is actually pricing in. And federal funds rate, just for reference, that's the short-term interest rate that really has a big impact on short-term bond yields. That is really influential on things like the 1-year, 2-year bond yield for U.S. Treasury rates. And I guess one of the things that is coming to mind is that not only is it possible that the Fed might be behind the curve as far as raising interest rates on the short end, because inflation is becoming a bit of a bugaboo here, but also the need to reduce their asset purchase program, I think, is starting to become a very acute need, not necessarily something that they could do, but something that they're going to have to do, because it's a little bit silly to think that the Fed should be continuing to buy, now 75 billion roughly of mortgage-backed securities and Treasury securities every month, when we're having some of the best growth that the U.S. economy has ever experienced. And so I think what this chart is suggesting is that the Fed is looking more likely to be behind the 8 ball as far as adjusting their monetary policy stance. That's a key variable for 2022. Interestingly, however, we do have I would say, a mixed bag of some macro variables, not necessarily positive or negative per se, but just something to keep an eye on. And I think while the expectation broadly tends to be that if the Fed stops raising interest rates, raises interest rates and stops buying assets, that the bond yields have to go up. That's actually not been the experience of the prior, call it 4 quantitative easing programs that the Fed has done since 2008. And they're laid out here pretty nicely in this chart from Deutsche Bank, where you can see the dark blue line here is the 10-year Treasury yield. And really every time that the Fed has been engaging in asset purchase programs or engaging in what they call quantitative easing, bond yields have actually gone up. From in 2008, it went from 2 to 4% roughly. And then when they stopped, rates drifted back lower. In 2010 to 11, bond yields actually went up during that time frame, then drifted lower. And that's been a really interesting byproduct, because it's very counterintuitive, because you would think that if they were buying bonds in the open market and trying to support the bond market with keeping yields low, then why are yields going up? And it's just one of these weird paradoxes that tends to happen. And I think that's part of what I think is framing some of our expectations, at least in small part, with interest rates in the future. And that is, there will be a lid on interest rates to how high they can go potentially. because of a variety of factors. As interest rates get higher, they tend to be more demanded by very long-term institutional buyers, people like pension funds, endowments, or even foreign governments, all tend to step in when bond yields hit certain rates that are much more attractive than their local rates. I mean, for example, the German 10-year bond continues to be below zero. The Japanese 10-year bond is, I think it's 9 or 10 basis points. And this is in the context of a 10-year US bond yield that's now at 1.75. So I think this is neither plus nor minus per se, but there is an upper level of interest rate movement that we're likely to see here over the next 12 to 18 months, is our opinion. The housing market continues to be a bright spot. I know a lot of folks are saying or asking the question, well, how is it possible that houses continue to go up in value when pretty much everyone probably owns a house, and where's the incremental buyer coming from? Well, there's a few dynamics at work here. I focused on housing quite a bit because housing equity tends to be a big source of wealth for most families. This is where their biggest asset is. And if that's moving up at a rate, currently it's at 18% year over year is the Case-Shiller home price index, then that is a very powerful, what they call wealth effect. And one idea that would support continued consumer spending, maybe not to the degree it was last year, but of a level that's still pretty meaningful. And where is that incremental buyer coming from? Well, interestingly, incrementally in small parts coming from the baby boomers. They continue to be very active in home ownership rates. I would not have thought that would have been the case. Gen X, of course, folks in my generation continuing to purchase houses as family formation continues on. And then increasingly since 2015, you can see here, millennials starting in the year, I believe it's 1980 and to 2020 or to 2000, are now making up an increasingly larger part of the housing purchases that are coming onto the market, which is leading to, again, all-time low in inventory for housing, price appreciation. And I think it's one reason why, while housing affordability will become an issue sometime here, probably in the near future, particularly as mortgage rates rise, it's still likely going to be well supported because, this younger generation needs to move out of the apartments they're in currently, or the townhouse that only has 2 bedrooms or something like that, into a larger space. And that's going to continue to, I think, put a floor under single family housing, which is a positive, but no question about it. And then, I didn't put it on the screen here, but estimates for for 2020 US growth are ranging anywhere between 3.5% to 4% in the United States, which is again, an above trend growth rate. There is some risk to that might be on the high side, but still this is an above trend rate where, if you recall, the US economy was growing at somewhere between 2 to 2.5% as a steady state rate pre-COVID. And so we're still at this above trend rate, which will be a nice tailwind to have as investors. So let's take a look at how Q4 shaped up across a variety of different asset classes. I would say also, if there's anything on the presentation you have a question about, or you'd like to ask a question, please drop that into the chat box, which should be on the bar on Zoom there. I'll grab it and try to address it as they come in, or if it's something that's maybe a little more nuanced, then I'll follow up with you directly with an answer to your questions. So let's take a look at Q4. In Q4, this is a picture of global stocks across a variety of different asset categories. Obviously, it's a very simplified version, but I think these are the major categories that capture the gist of the equity market performance. You can see the S&P had a pretty banner quarter, up almost 10% for the quarter, which is, again, that's a bit unusual, but not out of the realm of expectations by any degree, because stocks can have pretty wide ranges of volatility over short periods of time. The small cap index, Russell small cap index, was only up 1% roughly. International developed stocks were only up 2.4%, and emerging markets, despite starting the quarter off on a strong footing, ended in negative. Really, a lot of that, as you'll see here in a few slides, was driven down and lower by China, Chinese stocks. That was a market that had a very poor performance in 2021. Let's Stretching it out over the full year look, you can see here S&P US large cap indexes in black had by far the best performance of any major market that we're following here, particularly on this chart. There were a few markets that were exceptions that might have performed a little bit better, but I think the S&P led most global indexes to levels that weren't eclipsed by anywhere else. You can see the Russell 2000 index, after hitting a very quick 20% gain in early March, really didn't achieve much higher than that and ended the year at about 14.5% for the year. International developed markets underperformed the S&P again, up only around 12%, roughly 11.5%. Then emerging markets for the year were down roughly 3.5%. And maybe this would speak to how we were positioned in 21 and maybe what we got right, what we didn't get right. By and large, we still have across most of our accounts a very overweight position relative to a global index in US positions, still keeping a roughly 70-30 split between US and international companies. Within the international sleeve, the majority of that is in international developed markets, and a very small percentage is in emerging markets, which we'll likely looking at making some modifications to that position. We do still continue to have no exposure to small cap companies, and I think that was a decision that was well rewarded this year, particularly given the almost double the return of the small cap index within US large companies. One thing that we didn't necessarily get right this year, which I think is important to talk about what you got right, but also what you didn't get right, was the magnitude of volatility, particularly in the growth sector in Q4. What this chart doesn't show you here in Q4, near the end of the year, the Russell 1000 growth index took a pretty big hit. NASDAQ would also be another proxy for that. And something that I think had we been able to make some changes early in the year might have avoided some of that downdraft or positioning adjustments. But needless to say, we're pretty happy with our equity performance by and large. It's just there's going to be a lot of volatility between shorter term time periods. Fixed income wise, you can see this is the Q4 look. Junk bonds again led the way higher with a return of roughly 50 basis points or so. The broader high quality index was down 0.12%. The investment grade index was actually up 11 basis points, and the emerging market bond index was up 38 basis points. But if you had to net out this chart here, it'd be flat returns on fixed income, almost zero in most cases across the board. And this would speak to, I think, the longer picture for the year for 2021 for fixed income was a pretty poor year. And I think if you look back at Q1 of 21, our recommendation was, and what we actually implemented in our accounts was taking allocations from fixed income, dropping that bond allocation into what we call alternative income positions or into equity positions. And I think that, again, that decision was well rewarded, considering had we stayed in that position within our bond sleeve, we would have potentially lost some value if we were in an index. Now, our active portfolio is actually managed in some cases to generate a positive return, despite the fact that the overall bond index was negative. But neither here nor there, it's still not a very strong return out of the bond market. And this also speaks to our idea that bonds, particularly when we're in a situation where bond yields particularly look like they might be rising over time with inflation pushing them higher, should be migrating into a position of capital preservation as opposed to seeking out income. Because if you're going to seek out income in the bond world right now, you're going to be looking at things like junk bonds, or the very speculative parts of the bond market that to us don't really fulfill that capital preservation function, and therefore should be considered a little bit differently than other more traditional high quality bond investments. And then other assets, I just used a one-year picture here because not really worth talking about for the quarterly view, but on a 12-month perspective, you can see here a few assets that we do look at for opportunities. One is, of course, Bitcoin. Bitcoin is a digital asset that's now in a ETF format, using futures as the underlying asset that is owned in those positions. And if you had to guess where that ETF was approved, would you be surprised to know that the ETF was approved right around here in mid-November? And then, of course, Bitcoin went down about 70% from its peak. But that notwithstanding, we still think having an allocation to digital assets when the appropriate vehicle becomes available will be something that we would likely consider very closely, as it provides very valuable diversification benefits. The key to that decision, of course, is, are you sizing it appropriately so you're not losing sleep at night? And I think that's the real decision that we're working through it now. What is that appropriate sizing? And by and large, it's probably somewhere in that 1 to 3 percentage point, maybe even up to 5 in some aggressive accounts as a position size. Interestingly, U.S. REITs had a really strong year. People probably would not have thought that coming out of COVID, given all the hesitation. I think that was being baked into not only mall REITs, but also office REITs. And I do think, the future of office still is something to call into question, how much office is really needed now in a world of remote working. But that notwithstanding, the index composition of this US REIT index is the Vanguard VNQ index, is also important to keep in mind, because as office REITs and mall REITs have declined in value, what's risen in value pretty dramatically over the last 12 to 18 months has been industrial REITs, multifamily REITs, and things like data center and cell tower REITs. And so that's really what drove this US REIT index higher over the last 12 months, and something really interesting to just note. Now, I would say the forward-looking return for REITs is not very strong because yield has typically been a way you value most real estate, and REITs in particular. And a forward-looking yield on REITs right now of right around 2% or a little bit above that, at least on this index, is not a super attractive proposition at the moment. Commodity markets had a great year. You can see the DJP. This is the broad commodity index, up about 30%. And that makes a lot of sense, actually, given that commodities have been a pretty habitual underperformer for the better part of the last 10 years, particularly in relationship to things like equities. And so having these big up years in commodities makes a lot of sense, as a lot of what drove the commodity index higher were things that have been out of favor more recently, things like oil and gas or uranium or steel producers. Those commodities all migrated higher over the year pretty dramatically. You'll see a chart of that here in just a moment. But something worth noting, and I guess from a forecasting standpoint, commodities appear poised to have another positive year, although probably not as strong as it was this year. Again, because it takes time to bring projects online and supply online for a variety of different types of commodities, and that tends to be a very long cycle. So we think that this could be another up leg for commodities in the future. So that leads us, I think, from a context standpoint, into some ideas for 2022 and beyond. We're not necessarily in the process of forecasting 1-year returns necessarily, but more thematically, I think, longer term. And there's some ideas here that we still want to touch on that I think make some sense. So you can see here, the only modification we made, given the pretty substantial underperformance of small companies versus the S&P and large companies last year, was just upgrading that small and mid-sized company segment of the U.S. market to a neutral weighting. And of course, as you know, or as any followers of this webcast will know, we think that having an active approach in each of these areas is probably going to be a great way to add incremental return. We did downgrade, I think it was 2 or 3 quarters ago, our emerging market position to less attractive or unattractive, and still have the majority of all of our international exposure in developed markets. We think that's, as you'll see in a moment, we need I think a pretty solid reason to move off of this underweight / almost zero weight. And I don't see anything necessarily on the horizon quite yet. Bond market wise, broadly speaking, we've downgraded most of the bond market to a kind of a less attractive position in favor of what we call alternative assets. And those can be either liquid or illiquid, and even things like real assets, infrastructure, commercial real estate, and the like, as a result of this downgrade. So this has really, I think, been pretty consistent, but junk bonds at this point in the cycle for us continue to represent very little incremental value because the price can take away all of that income that you've earned in a matter of just a few days in the bond market. So we don't think the risk is worth the reward in that perspective. And then here's just some general notes for 22 and beyond. One is, we still want to be very mindful of risk and return across asset categories. We do that through some of the capital market assumptions that we make. We'll certainly be able to share some of that with you when those are completed. But we're, I think, evaluating everything with a clear lens at the moment because there's no glowing opportunities at the moment. We have to be very judicious about our decisions and also risk management. Negative real bond yields, which again, we'll touch on in a future slide. They continue to present the unattractive bond returns. So therefore, we have to make decisions based on that attractiveness. And negative real returns also present, or support valuations that might seem a little high right now in other assets like equities or digital assets or real estate. So it's important to keep that in mind. But we are increasing portfolio liquidity, and that's been a priority of ours. Starting as soon as I think the first quarter of last year, we started to incrementally increase cash levels. We'll likely do that again sometime in the near future as rebalancing efforts take hold. But really, while we are potentially losing return to inflation, having in a short-term bond ETF, having that capital available to use when the markets get really volatile has proven to be very valuable over time. So we want to make sure we maintain that ability to act and act quickly. As far as equities are concerned, large dispersion is showing up, and that's across various categories, and it's noteworthy because we have started some of the migration within our equity sleeve from our large cap growth sleeve to a more of a mid cap growth sleeve because of just the substantial differences that have occurred more recently. Towards the beginning and middle of December, we started that effort. And we think that now is an interesting time to start that migration. Nothing wholesale yet, but more incremental. Active management certainly is something we think is poised to do well in the current environment. It's not ideally suited, as we found sometimes across certain parts of the large equity market, large cap growth equity market, but we certainly have learned some valuable lessons, and we'll move and take those into future decisions. And we continue to have an underexposure to emerging markets. We're waiting for a catalyst to get more aggressive there. Fixed income, I think it's the same story. I know it's probably boring. It's kind of a boring topic to talk about. Then again, I think fixed income should be boring, and that if your fixed income isn't necessarily too boring, then you're taking too much risk. So keeping that a higher quality short duration actually worked really well for us last year, particularly relative to the return you would have earned in an index. And our goal there is to preserve capital. Inflation, it does appear, is leveling up. So we will probably see a higher normal level of inflation into 2022 and beyond for the foreseeable future. One position that worked really well to kind of benefit from that uplift was our short-term TIPS position that we held for most of the year last year. I think in a year where bond yields were negative or bond returns were negative, that short-term TIPS position, by the time we closed it out, was up close to 5%. So that was I think a good pivot to recognize during a year where that was very challenging for fixed income returns. And then alternatives, again, this is an area we've spent a lot of time continuing to develop and build and evaluate new strategies in that area. But I would point out that intercompany volatility, sector dispersion creates good opportunities for alternative strategies that are going long and short various companies or long and short various bonds, things of that nature. This rising volatility, as I've talked about before, is only getting better, creating better opportunities. We are approaching, I think, a potentially attractive entry point for some digital assets or cryptocurrency. We will continue to be patient and wait for the approval of a spot ETF, not a futures-based ETF, but a spot ETF, to see if we can get a better vehicle to express that outlook. But in the meantime, we'll continue to be patient. And I think that patience has actually been rewarded in the fact that, I think Bitcoin, since the ETF that's futures based came out 2 or 3 months ago, is down, 30 or 35%. But also on the private side, as some of you all know, we have private opportunities looking at those areas, and we're very excited about what we see on that front. So let's get into some of the meat here. Again, I'll try to move through this a little bit quickly, but I think if I had to sum up our view on U.S. equity markets, I still think it's a positive outlook. Yes, there's going to be a lot of volatility. There's going to be some scary, very short drawdowns, like we're seeing here in the first part of January already. But if you were to sum up all of the company estimates that are starting to be published about 22, 23, and beyond, you'll find that S&P earnings are still set to grow and grow in a pretty decent way. So, you're talking about high single-digit earnings growth, in some cases maybe greater if you're in active strategies. And if we can get, high single-digit, low double-digit earnings growth with some valuation compression, then that actually does a great job of keeping returns in our equity sleeve positive over, calendar years, which I think is really important to fulfill a lot of those financial plans that we have running in the background for everybody. But what's driving some of this earnings growth? Well, it's a combination of things that sometimes I think we forget about, but it's productivity enhancements. COVID, by some estimates, brought forward a very sizable amount of productivity enhancements, artificial intelligence advancements and automation, medical technology advancement. These are all adding to, how can the market earnings continue to grow? And this is, I think, just some reasons why that could be the case. And it is our base case. I also say, as the title for this slide, we're not fearing recent gains, because I know that the thought can be in some people's mind that, if we just had a big year in the S&P, 25% year, doesn't it mean that the following year has to be, negative or not so great? Well, certainly, I think the idea that we won't get as good of a back-to-back 25% year is very, very low. I mean, that's likely not to happen. But as you can see here, using this whole time series, I think this time series goes back to 1950. If you use the whole time series, the average return following years that are up 25% is 9%, but more importantly, your hit rate is 72% of the time. So you've already got a better than 50% chance that markets are going to be positive this year. And if you use just the data series, that was all years from 1950 to 2020. If you use just the years above here, where we had just 25 or better, then you're looking at 85% chance of a positive year with an average return of, call it 12%. And that would actually nest pretty nicely, either of these actually, with our capital market assumptions, these are probably a little bit higher than that. But high single digit, I think, should be the expectation for equities for the foreseeable future. And one of the things I did want to also point out is this is another price chart, but what you see on the chart here is a 2021 view of what I call higher risk market segments versus the S&P, or really just proxy for speculation in some cases. And I'm sure most of you all have heard of these subsegments because they've been hot at various points, but I present this chart to just suggest that the market and its participants have actually done a pretty good job of trying to stamp out some of the speculation that occurred earlier in the year and in 2020 as well. So you have things like, Bitcoin is, I'll touch on that in just a moment. But recently IPO'd stocks, IPOs can be a proxy for, market liquidity and speculation. The IPO ETF, it's just symbol IPO, was down 10% for the year. That's a pretty good negative return for, a year where the S&P was up, 29%. But then you have these other asset categories like the SPAC ETF. SPACs are special purpose acquisition corps. That ETF that comprises recently SPAC companies was down 37%. That's a pretty negative return and a good job of bringing out speculation. The ARKK, the ARK Innovation ETF, ended the year down 23%. Again, in the year where the S&P is up 30. The biotech index, which we actually like biotech as an opportunity right now, was down 20% for the year. So all of these highly speculative, non-cash generating business segments of the equity markets produce pretty negative returns. Bitcoin, I just wanted to share this. This is kind of a proxy for liquidity, but also, I guess, in some would call it a proxy for speculation. But we had a pretty massive volatility and also drawdowns throughout the course of the year. So Bitcoin underwent last year drawdowns of greater than 50% twice during the year, and that's a pretty marked decline over the course of that year. So there is a lot of, I guess, feet pedaling under the surface of the lake that's maybe being obfuscated by the S&P's return of 29. So I say this to say, speculation, speculative parts of the market did have a derating, a pretty meaningful derating last year, which is positive. The growth versus value debates. I know this is something that we like to touch on every now and then. Is our value stocks going to do better than growth stocks over the long term? Well, I think over the, I've zoomed out from 2000 to 2022 in the larger view, but zoomed in more recently on the last 12 months, or I guess last 18 months view. If the line is going up, that means that growth is outperforming value, Russell 1000 value. And if the line is going down, it means that the value index is outperforming the growth index. And I think maybe the net of what I'm trying to say here is that this is where we are as of last Friday, where value is now outperforming, but really we're not going to pay too close attention to these gyrations in growth versus value until we reach some of these like key resistance levels that are really just indicators to make us perk up. Because if you look at things on too short of a time frame, then you run the risk of making poor choices because of the volatility, letting make that decision for you. So netting it, I guess it's too early to say, for lack of a better term. And I remember talking to some clients last year about, are we on the precipice of, small caps now coming back into favor? And is that something we should be rotating into? Or are you guys considering it? And I always said, well, yes, that's something we're considering, but starting valuation for small companies, at least in the Russell 2000 index, which is the main small cap index, still had a pretty aggressive valuation tilt to it. And I couldn't necessarily find a reason to liquidate our large company positions in favor of a small company position. And I think that's, while this little difference here was pretty, emotionally hard to bear, at least for me, making that decision, it actually has ended up working out quite well, as I shared earlier in the presentation, where small caps or small companies underperformed the S&P by about half last year. And I think, again, there's really no reason to move off of this position quite yet, because it does appear, for a variety of reasons, that large cap, particularly technology companies, are quite well entrenched relative to their smaller company cohorts, that the barriers to entry that they're continuing to throw up against these smaller companies are quite hard to overcome. I would also touch on here, so where are some opportunities? I would say cyclical industries of the type that are here continue to have or attract attention. As maybe some of you all have noticed, we do have, or are carrying right now, a bit larger of an energy related exposure than we have in quite some time. And that was really driven by opportunities we saw earlier in 2021. But what's driving those opportunities, I think, is really the bigger question here. And I think what this chart tells you here, it's just, as it says, global investment in energy intensive industries relative to its 10-year average. And so relative to the 10-year average, and this is for estimates for 2022, 23 and beyond, that, relation in the energy, oil and gas producing sectors, there is 40% less investment going into that sector than the 10-year average. Metals and mining, shipping, steel, refinery, biotech. And these are all, I guess what I'm saying is, another way of saying it is that these are undercapitalized businesses now, or segments that have, I think, a combination of very reasonable starting valuations, dividend yields or cash flow that is very attractive, and also key expectations are really low. So, it doesn't take a lot for some of these companies now to overshoot to the upside and in a very fast way. So not that we're going to be moving all of our portfolios to oil and gas or metals and mining, certainly we want to make sure we're being conscious of some of the environmental and social considerations of doing that. But I think tactically could be opportunity to look at resource-based companies, given some of the very attractive combination of these items down here. Another question that comes up frequently with clients is, are international stocks, still worth having in a portfolio, because they've underperformed for so long? As you can see, this chart right here shows this is the longest period of time that international stocks have underperformed U.S. stocks. So the way to read this is, in the dark gray bars, it shows you the years and the magnitude of outperformance. And the gray is for U.S. If it's a purple bars, that tells you that the international EFA markets are outperforming and by the magnitude in years. And so how long will this persist? Well, we don't know with any certainty, but nothing goes on forever, of course. And I think there will be potentially periods in the future where diversification of international positions and having international stocks will be quite beneficial to a diversified portfolio. Again, we haven't seen the benefits really of that diversification quite yet, but at some point that will show up because there are reasons for these positions to have a divergent performance. One of which I can think of, and what might some of those be? One would be if the U.S. dollar starts to move lower in value versus competing currencies. That's, as you know, something that, or as I've been mentioning in this podcast or webcast, the dollar is something we're looking at as a tell to see if the risk-off sentiment might be approaching, or regulation in the U.S. that hasn't yet to occur where it has in Europe. So that those are two items I would point to that could pivot some of this outperformance to favor international companies versus U.S. Lessons from Japan. I brought this up in the prior webcast, but just worth pointing out, this is the Nikkei going back to 2000 or 1980, and showing you the performance of this index all the way through 2022. You can see that we still haven't seen or eclipsed the peak of the Nikkei back in 1990, 91. And the reason I show this is for two reasons. One is the U.S. has had a very unusual experience of rebounding from prior peaks very rapidly. If we move into a period in the future where we don't reestablish or eclipse prior peaks very quickly, then I think the investing environment will get a lot more challenging. So we have to maybe prepare for a longer time until recovery, for lack of a better term. But the other reason I point this out is that during this time period, while this index went down, would you be surprised to know that actually I think 90% of active managers that in equities in Japan over this 20-year period here, from 90 to 2010, outperformed this index. So I think there's opportunity, or there are reasons to consider what we're recommending from a active management perspective, and just manifesting itself particularly in markets like Japan, which I think are pretty close in makeup and demographics to the United States. One thing we would point out is the persistent underperformance in Chinese equities. It does appear that there is boundless opportunities and growth potential in a very large market, consumer market like China. But how these opportunities for growth actually translate into stock prices for U.S. investors is a whole different matter. And you can see here for 2021, the broader Chinese index, this is the FXI, it's the largest 50 companies in China, end of the year down 17%. The Chinese technology sector ETF, is the CQQQ, was down 20% after reaching a 40% return for the year. And this is, I think, certainly something that we need to keep in mind, but, rule of law, property rights, these are all really coming into question, I think, in some investors' minds. And there is a possibility that, Chinese companies start to get delisted from U.S. exchanges, which would also represent another hit to that cohort of stocks. And in our opinion, just makes Chinese stocks for the foreseeable future uninvestable in large part. Now, there are some names there that will be survivors. that'll likely be fine longer term, like Alibaba and some of the bigger ones that are more multinational companies there. But by and large, index investing in China, in our opinion, is certainly not worth doing at this point. And then fixed income, again, I know it does seem like bond yields are set to shoot off to the moon here because of inflation being what it is. 6.8%, I think, is the current level of CPI for November. December's reading should come out here at the end of this week. But I guess what I wanted to point out here is that there does seem to be this cap on yields that, despite what happens with either inflation or international investors, there always seems to be this upper bound that we run into for one reason or another. And so, using the 2013-14 timeframe, this is around the taper tantrum, if you recall, when Ben Bernanke said they would start curtailing purchases. 2016 and 17, this is when I think China started to have capital issues with their currency, and then now more recently with COVID. What tends to happen is that we overshoot to the upside for a few months, maybe 6 months or so, and then start to drift back lower with that longer term downward push in yields as international investors come into buying these securities for their attractive yield relative to what they could buy, or retirees looking for secure income, things of that nature. But that notwithstanding, I think over the short to intermediate term, we will probably see higher levels of yield in the 10-year bond index, and therefore should expect some pressure in that part of the portfolio. So we've made over the year of last year and more recently some changes to that part of the portfolio. And then you can see, longer term, this is from 1958 in the blue line, 10-year bond yield down to where we are December 31. The progression and kind of averages over those timeframes, and at levels for inflation, so on and so forth. And I guess my main question is, is this a time for breakout? Are we really thinking about how we're going to break this 40-year downtrend in bond yields? And I still think there are a number of factors that will keep a lid on this from moving up to, call it, 1981 levels or anywhere close to that in the near future. But we do have to keep in mind that that is a possibility. So we don't want to invest as if that's a certainty by any stretch of the imagination. And then this is the chart of commodities I just wanted to share before we move into some of the risks to the outlook here. And you can see, broadly speaking, 2018 was just an abysmal year for commodities. By and large, almost every single commodity was down, 10, 15, 20%, followed by, pretty positive years in 19, some sideways years in 20, and then 21 was really a bespoke year, depending on commodity. And so, you can see when you have negative return years in commodities, that just means that, producers aren't likely to invest in those areas. And I think that's exactly what you're seeing here with, particularly in oil and natural gas, a number of years of negative returns, followed by now in 21, a very positive year, could potentially lead to some investment or incremental investment, but still have a long way to go before we get to, levels that might be considered, aggressive on the upside. One area of the market that I have talked to a couple of clients about that we just recently did a deep dive on with our investment team is this EU carbon credits market down here. You can see that's been a really remarkably resilient and strong part of the commodities market. These are tradable carbon credits that if you're a utility or an industrial company in Europe, you're required to have a certain level of carbon emissions. And if you go over that, you have to buy credits to compensate for that over emissions, essentially, that you're generating. And this is a really interesting, now investable part of the market through some ETFs that we've looked at very, very closely, and haven't made any decisions on it one way or the other quite yet, because we want to get to some of the mechanics of the market. But it's just a really interesting, subset of the markets that could potentially be worth looking at in the future, particularly if, we're in a world where policies by governments are meant to make carbon more expensive, then these carbon credits should, by extension, move up in value over time. But commodity markets, I think 22 we would forecast to have a positive return, just given, again, some of the substantial underinvestment that occurred in prior years, 15, 16, 17, 18. and beyond. So what are some risks to the outlook? This is a new kind of section that I wanted to just layer in here, because I know some clients have some thoughts around what some risks are that are out there that are maybe obvious, or maybe some that aren't so obvious. And really just try to distill them down to maybe the top 3 that might have the most meaningful impact. The first and foremost, I think the biggest risk to asset markets or any financial market right now would be the risk of inflation. Inflation is remaining and has remained above 5% for at least 12 months now, actually 9 months, going on 12 if we get a reading here above 7 next month. And if inflation stays high and supply chains don't unlock, and OPEC doesn't produce more energy, or for whatever variety of reasons, if inflation doesn't start coming down, then I think the playbook for the 1970s then gets put in place, which means that multiples or like PE multiples on stocks have to come down, and bond yields would likely move higher. Now, the Fed, of course, is suggesting they can keep a lid on yields, but take it for what it's worth. I mean, they certainly will tell you that, but can they actually do it is a whole other question. And I think underinvestment in key commodities could be reaching a tipping point where we're getting price levels that are starting to create some pain or anxiety for consumers. And so we'll see how this unlocking takes shape into 22. But that is, I think, one of the biggest risks for markets, is that inflation stays above 5% for a whole lot longer. Second one is that maybe related to that is that the Federal Reserve makes a monetary policy mistake. So either they tighten financial conditions too rapidly, which tanks a variety of asset markets, or they wait too long to take action in raising interest rates to contain inflation, in which case they inflate a bubble in asset prices that blows off spectacularly. So this is where I was saying the Fed has got quite a tightrope to walk right now, of trying to be both careful but also forceful in the actions that they decide to take. And then the final risk, which should not be overlooked, and having some experience with foreign soldiers or the Russian soldiers in my time in the military, we cannot underestimate some of the geopolitical opportunism on the part of Russia. And as you may have noticed in recent news reports, not only does Russia occupy Crimea, but they've been threatening to invade Ukraine potentially if things get out of hand. But also they have sent troops into Kyrgyzstan, and now troops into Hungary to quell some social strife and social issues that have been perking up in the former Soviet satellites. And then, of course, if China decides to take any action on Taiwan, that destabilizes trade relations with the U.S. and European allies, which could, of course, lead to an accidental kinetic engagement of some sort, which we don't want to necessarily go down that rabbit hole too much. But definitely want to make sure that we're keeping some of these things in mind, because if some of these things do happen, then we have to have at least something in the portfolio that might offset some of the potential negative outcomes that are associated with that. So I think that takes us to the end of our, okay, well, here are just some takeaways. And again, apologies on the slightly longer format this time around, but I do think it's important to review and give a more thorough outlook in these market matters, particularly since Hank had another engagement and where he couldn't make the webcast today. I feel like I just want to give a more meaty presentation. So here are just some key takeaways for everyone to think about and what we're thinking about, and that is we still favor stocks over bonds for now. There will be at some point a level in the bond market that makes bonds attractive from maybe a returning them back to a more normal weighting. But for right now, we don't have any aspirations of doing that. And we continue to recommend potentially slightly higher allocations to stocks, despite the strong performance year to date 2021. Active strategies are a preferred way to do that. We do favor also alternative strategies, whether those are liquid or private over bonds, because again, if we're going to compartmentalize our bond portfolio's role into a capital preservation mandate, then we need other ways of generating return. And the good news is higher levels of stock and bond volatility do improve the return outlook for alternative strategies. Some of that you'll see in future webcasts and the private markets update, some of that performance coming through. We are looking for new ways to access new asset categories or strategies. And I think I talked about those briefly earlier, but things like digital assets would come in the ETF format on the liquid side. And then on the venture capital or hedge fund side, those would be available typically only in the private format, but we do have some ways to get access to those. And I just wanted to say here as well that 2022 will likely be a year of blocking and tackling, where really portfolio rebalancing, cash level management, and position adjustments are going to be all key, I think, to helping frame out a positive return for portfolios over the course of 2022. Okay. Thank you for sticking with me through this far. And I just wanted to say, if you did have any questions, please drop those into the chat feature. And I do see there are a couple in here already, which I can address right now. But one I was going to say or address here is the current market encouraging any current rebalancing? So we do set out for equities a level of the S&P where we will engage in rebalancing. I would say a full portfolio level rebalancing is likely not going to occur. However, you may have noticed back in December, we did some single position adjustments to try to account for either outperformance or rebalancing back up to target in the case of any underperformance that might have occurred on single positions. So I guess maybe the shorter answer is we're not quite at that level yet. I think the target we have for our next rebalancing for our equity sleeve is right around 5,000 on the S&P on the upside, and I think it's at 4,200 or 4,000 on the downside. Maybe I hope that gives you a framework to think about from that perspective. Another question comes in here is, what do you attribute the inflation surge to? I think is a combination of factors, as these answers always are the case, but a pretty chronic underinvestment in our supply chain for commodities, I think, is really what's pushing a lot of the commodity complex higher. As I mentioned, the commodity complex has been pretty substantially decapitalized or undercapitalized for the better part of the last few years. And I think we're now starting to see the byproduct of that, particularly as it relates to things like oil and gas, but also even things like lithium. I think we need to consider the demand for, electronic vehicles and electrification of our grid is going to require many magnitudes of order greater of lithium and key components of rare earth metals than we currently have in production right now. So we're going to need to find some new sources of these, and sometimes they're going to be in places where people don't want to drill and find, like national parks or something like that. So there's going to be, I think, a tension there that exists, and we're going to have to work through that. There's that, but also the number of people in the workforce. I think the quits rate, the number of people actually quitting jobs, is a really interesting indicator, because it tells you that if people are quitting their job, we're at the highest level of quit rates. I think it's like 10 million or something like that over the last year. It tells you that people are quitting for better opportunities, and they could potentially get paid more at other places. The quit rate, I think, would suggest that the labor market is getting tight and increasingly tighter. And if the labor market is getting very tight, then companies have to increase the incentives. They have to pay people and benefits and such to attract talent to their organization. And that in and of itself is inflationary. So you've got this labor market piece that's very tight. Labor market is creating some inflation. We also have the commodity market piece, which is creating a higher cost of inputs for goods and services, for goods. And that's creating, I think, of where a lot of this inflation is coming from. It can come back the other way, but I think it's more likely to be in the commodity side as opposed to the labor side. Another question here is a 25 basis point quarterly Fed increase projection pretty much baked into the cake. Actually, I was looking, great question. I was looking this morning at, what is the market pricing in over the next 12 months is I think a good proxy for what we should expect from a Fed increase. And so the market currently has a 90+% probability that we're going to get 4 Fed rate hikes in 22. So that would basically mean that the Fed funds rate would go from where it is essentially 0 right now to 1% by the end of 2022. That's a long way. We'll see if they can get there. But that's currently what the market is expecting. Former Fed Governor Dudley is expecting, written in an op-ed in Bloomberg over the weekend, he's thinking that the Fed needs to get to somewhere between 2 and 2.5 by the end of 2022. That would be very aggressive tightening, and I think would be pretty detrimental to most asset markets. It's likely going to be somewhere in between. Thanks for joining us. Really look forward to speaking to you again sometime next month. And if you have any follow-up questions, feel free to reach out to your advisor or reach out to me directly, and I'll get back to you as soon as we can. Thanks.